Hello, I'm Michael Ruger. I am the managing partner of Greenbush Financial Group, and I'm going to be sharing with you today our 2023 market outlook. Now, while the market headlines this year have been dominated by this battle with inflation, and it hasn't been the most favorable year for stocks and bonds to say the least, the market unfortunately is going to trade inflation for a new problem going into 2023. I'm filming this on December 15, 2022, and this week we got a bunch of meaningful inflation and Fed data. On Tuesday, the inflation reading for November came out saying inflation had dropped to 7.1% from the 7.7% it was in October. I mean, that's a meaningful drop in inflation. And then the Fed came out yesterday only increasing the Fed funds rate by 50 basis points instead of 75. Now you would say, well, isn't this meaningful progress? Why such a gloomy outlook for 2023? And the one word I have to answer that is history. If you look at the economic indicators behind the scenes, a lot of those indicators that we're watching are flashing red, saying there's a very high probability of a recession within the next 6 to 18 months. While the Fed has been successful at bringing the inflation rate down over the past few months, we believe the real battle with inflation will begin when the inflation rate gets down around 5 to 6%. These big advances from these super high levels happen quickly and more easily, but then inflation really starts to get sticky when you end up in the middle of the range. And reminder again, the Fed's target is 2% inflation. We peaked at about 9%, and they got to go all the way down to 2%. And a fun fact about history is every single time throughout history, when the Fed has had to reduce inflation by more than 2%, every single time it's caused a recession in its wake. So we're not going down by 2, we're having to go down by 7 with still another 5% to go before the Fed really declares victory. I would not be at all surprised if the inflation rate gets down to around 5 or 6% by March or April of next year. You have a softening consumer, you have the housing market slowing, you have energy costs down substantially. All those things are going to help prices move lower over the next few months. But then that inflation gets really sticky because of the labor market. The head of the Fed yesterday, Jay Powell, mentioned multiple times that wage growth remains far too high. And the reason why that's a problem on the inflation front to get down to their 2% is if people are employed and they're making higher wages, they can keep paying higher prices. The ugly part of this whole situation with the solution to this problem is people unfortunately have to lose their jobs. It has to force lower wages. It's ugly getting to the other side of this. This will be an added challenge for the Fed because companies are very reluctant to let go of any employees because of the shortages in the labor force. It's so tough to find employees that they're worried if they lay them off and then the economy starts to recover, how are we going to find the talent we need to grow? So companies could put off laying off employers longer than they should. So you get this slightly gradual increase in the employment rate only for it to spike because companies waited too long. Here is a history lesson about the unemployment rate. So when you look back at the past 9 recessions that we've experienced in the US economy, my question to you is, how many times has the market bottomed before the unemployment rate began to rise? And the answer to that question is 0. The market has always bottomed in the past recession after that unemployment rate has already begun its rise, which makes sense because it's tough for the stock market to find a bottom and make headway when people are losing jobs. JP Morgan has a great chart illustrating exactly how this trend works. So if you look at this, while it looks like there's a lot going on, each of the charts that you see there, there's 9 of them, are each of the past recessions. Now the purple line you're seeing, that's the unemployment rate. The black straight line that you see on each of the charts, that is where the stock market bottomed during the cycle, and that gray shaded area, that's the recessions. Now, if you look across all of these charts, what you see with that purple line is it begins to rise, and that straight line does not show up, which indicates the market bottom until after. So those of us that believe that we've already seen a market bottom, you may be on the wrong side of history. This rise in the unemployment rate is going to give birth to this new big problem that's going to face the economy in 2023. We are going to trade our inflation problem for the problem of a weakening U.S. consumer. If people are losing their jobs, they can't spend money anymore, they could foreclose on houses, companies are going to be spending less money, and that could be enough to deliver our 2 negative quarters of GDP, which would then signify a recession. This could very well create an environment where the Fed has its hands tied. They're going to be watching the economy contract. Normally, the Fed would be stepping in to aid the economy by lowering interest rates to get it going again. But if inflation is still at their 4 or 5% and they're still trying to get down to 2, they may not be able to lower rates to help. And this is similar to what happened in the 1970s, where they actually made the mistake of lowering rates too soon, and it reignited the hyperinflation. And Powell said that a few times yesterday, that they're not going to repeat that mistake. This naturally leads us into the question, is this going to be a mild recession, severe recession? How long do you expect the recession to last? And honestly, sitting here today, we have no idea. There is no way to know. I think it's going to be very important as to when the economy starts contracting, where's the inflation rate? If it starts contracting and they still have a long ways to go before they can get the inflation rate down to 2%, that could prolong the recession. It could also increase the severity of it because they can't heal the economy fast enough and other things start breaking. While this environment creates a more gloomy outlook for the stock market in the first half of next year, it could end up being a very good opportunity for the bond market. Bonds have been beaten up tremendously in 2022 because rising rates are the enemy of bonds. And if you look at bond market returns going back to 1976 in this chart, bonds usually create these nice positive returns. Every now and then they have some lower years. But if you look at this year on the right-hand side of the chart, we've never really seen a down 11% in a single year from bonds, and that could very well reverse itself starting in 2023 as the Fed stops raising interest rates. And if we end up in a recession and then they have to reverse course and start lowering rates, that could bring positive returns back to the bond market. One of the other important economic indicators that we look at to determine the probability of a coming recession is the yield curve. When there's a yield curve inversion, without going into the technical details, basically a yield curve inversion is a warning from the bond market to the stock market to say a recession may be coming in the next 6 to 18 months. And if you look at the yield curve over history, going back to 1970, this is the chart. Each of those arrows are where the yield curve has inverted over time. And those gray areas on the chart are where the recessions happen. And if you look, after each of the inversions, normally a recession has followed within the next 6 to 18 months. And if you look at our arrow, which is where we are on the right-hand side of the chart, we are heavily inverted right now. So unless you think we are in some sort of anomaly right now, there is a high probability we will see a recession in the next 6 to 18 months. Going into 2023, I think it's very important to be realistic about the returns you're expecting from the stock and bond market next year. The market is admittedly facing a lot of headwinds. We could very well have a mild recession. If inflation comes down very quickly because of the recession and the Fed is able to reverse course and start lowering rates before the end of the year and come to the market's aid, we could very well see a bottom in the equity markets at some point in 2023. But sitting here today in December 2022, it's just difficult to know what to expect. So you're going to have to be very proactive about your investment decisions and tracking the data as it comes in. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.